Good morning, everyone. Well, Friday's market action was largely in preparation for the big week we have ahead of us. Tomorrow sees a Reserve Bank of Australia meeting, Japan's Tankan report, and the global manufacturing purchasing managers indices. On Thursday, we have the long-awaited European Central Bank meeting, and on Friday, the U.S. non-farm payrolls. With all that ahead of the market, investors seem to be positioning themselves appropriately. The ECB meeting remains the biggest event. The steady decline in peripheral Eurozone bond yields suggests that there's still some hope that the ECB will stop sterilizing the bond purchases that it made through the securities markets program. In that context, the market's going to be watching this morning's announcement of the March CPI for the Eurozone very closely. The market's expecting inflation to slow to plus 0.6% year-on-year from 0.7% in February. Friday's surprise plunge in Spanish CPI into deflation took Eurodollar down to 137.05, a level last seen the day before the last ECB meeting. But the fact that German inflation wasn't any lower than forecast caused some disappointment after the surprising Spanish data, and also after a big drop in inflation in the German region of Saxony. I think we would need to see Eurozone inflation coming in below that estimate today in order to get another challenge of that level. Elsewhere, the dollar is generally higher against the other G10 currencies, particularly against the yen. It appears that some risk premium is developing in the yen ahead of tomorrow's Tankan report. The current condition indicators are expected to rise, but the outlook figures are expected to show that firms expect some slowdown after the consumption tax hike in April. Also, last week's retail sales figures, which showed only a small rise in spending in February, despite the impending rise in the tax, is worrisome for the Japanese economy. Last time the consumption tax was hiked, there was a rush to buy ahead of the rise, but with wages depressed and prices rising, families now have little scope to expand their spending. This increases the likelihood of more easing by the Bank of Japan. It also suggests a further squeeze in household savings relative to investment, and therefore a fall in the current account surplus, perhaps even into deficit. That would also be yen negative. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.